Hey everyone, welcome back to the Options Blueprint, where we break down advanced option strategies that can transform your portfolio. I'm Alex, and today we're diving deep into one of our favorite topics, credit spreads.
And I'm Ben, excited to join Alex for this episode. Credit spreads are truly a game changer for traders, especially those working with smaller accounts looking to generate consistent returns in various market conditions.
Absolutely, Ben. Before we get into the nitty-gritty of advanced techniques and real-world experiences, let's quickly recap what credit spreads are for our newer listeners.
Great idea. A credit spread is an option strategy where you simultaneously sell one option and buy another option of the same type, either puts or calls with the same expiration date but different strike prices. The key is that you receive a net credit when you open the position, hence the name credit spread.
And there are two main flavors, right? Bull put spreads, which profit when the market stays flat or moves up, and bear call spreads, which profit when the market stays flat or moves down.
Exactly. And what makes credit spreads particularly attractive is that they require less capital than strategies like covered calls, offer defined risk, and can be profitable even in sideways markets, something stocks simply cannot offer.
I think that's what drew both of us to credit spreads in the first place. Speaking of which, Ben, why don't you share your experience with how you got started with credit spreads?
Sure thing. I actually stumbled into credit spreads after a pretty rough start with directional options trading. I was burning through capital trying to predict exact price movements with naked calls and puts. One particularly bad earnings season, I lost about 40% of my account in just 2 weeks.
Ouch. I think many of our listeners can relate to that pain.
Definitely a learning experience. After that disaster, I stepped back and committed to education. That's when I discovered credit spreads and the power of becoming an option seller rather than a buyer. The defined risk aspect was a game changer for me. Within 6 months of switching to primarily credit spread strategies, I had not only recovered my losses, but was consistently generating 3 to 5% monthly returns on my account.
That's impressive and speaks to the power of proper risk management. My journey was somewhat similar, though I came from stock trading. I was frustrated with needing significant price moves just to make decent returns. When I shifted to credit spreads, I found I could generate income even when my directional bias was just slightly bullish or slightly bearish. The market didn't need to make big moves for me to profit.
That's such a critical point. With credit spreads, time decay works in your favor. While stock traders are sitting there hoping for movement, we're collecting premium as options naturally lose value approaching expiration.
Exactly. Now let's talk about some advanced credit spread techniques that have worked particularly well for us. One approach I've found success with is what I call the sweet spot entry. Instead of just putting on credit spreads at any time, I wait for volatility to spike.
Selling premium when it's rich. Classic.
Precisely. For example, last month when we had that sudden 3% drop in the S&P 500 on inflation concerns, implied volatility spiked. I sold bull put spreads on quality companies that had been dragged down with the market but had solid fundamentals. The premiums were nearly double what they'd been just days earlier.
That's a great approach. I've also found success with what I call laddering my credit spreads. Instead of putting on one large position, I'll split it into 3 smaller ones with different expirations, maybe 20, 35, and 50 days out. This creates a constant income stream and reduces the impact of any single expiration cycle going against me.
I really like that strategy. It diversifies your time risk, which is something many traders overlook. Speaking of overlooking things, let's talk about some common mistakes we see traders make with credit spreads.
The biggest one I see is selling strikes too close to the current price just to collect more premium. It's tempting to go for those juicier premiums, but probability of success drops significantly.
Absolutely. I remember putting on a bear call spread on Tesla when it was on a strong uptrend just because the premium looked attractive. The stock blew past my short strike within days, and I took a maximum loss.
That's a painful lesson many traders learn. Which brings us to another common mistake, not respecting market trends. Credit spreads work best when you're trading with the trend, not against it.
Right. Bull put spreads in bullish or sideways markets, bear call spreads in bearish or sideways markets. Fighting the trend is a quick way to blow up your account. I've also seen traders get into trouble by overtrading, taking too many positions at once.
Definitely. Position sizing is critical with credit spreads. I never risk more than 2 to 5% of my account on a single trade, regardless of how certain it seems. This has saved me numerous times, especially during unexpected market events.
Like that flash crash we had back in early 2024. I remember you were telling me about your SPX credit spreads during that time. Want to share that story?
Oh man, that was a close call. I had several bull put spreads on SPX that were comfortably out of the money until that sudden 5% drop over 2 days. What saved me was having my position sizes small enough that even though a couple of spreads hit max loss, it only impacted my overall account by about 7%. Had I been overextended, it could have been devastating.
That's a great example of risk management in action. Let's shift gears and talk about market conditions. What environments do you find most favorable for credit spreads?
Credit spreads really shine in moderate volatility environments. When IV is in the 40 to 60% range, premiums are juicy enough to make the risk reward attractive, but not so high that it signals extreme uncertainty. I also prefer range-bound markets or slow trending markets rather than highly directional ones.
I completely agree. And looking at our current market environment, what are your thoughts on deploying credit spreads right now?
Currently, I'm cautiously bullish, but wary of potential volatility. With the Fed signaling potential rate changes, we could see increased choppiness. In this environment, I'm focused on wider spreads with higher probability of success, even though that means accepting smaller premiums.
That's smart. I'm taking a similar approach, but also being very selective with underlyings. I'm sticking to high liquidity ETFs and blue chip stocks rather than more speculative names. The last thing you want with credit spreads is to get caught in a low liquidity situation when you need to adjust or close a position.
Excellent point. Liquidity is crucial, especially during market stress. You mentioned adjustments. Let's talk about that. What's your approach to managing credit spreads that move against you?
I follow what I call the 30-50-70 rule. If a spread hits 30% of maximum loss, I review the trade and confirm my thesis still holds. At 50%, I seriously consider closing or adjusting if my outlook has changed. At 70%, I almost always close to avoid the risk of hitting max loss. This disciplined approach has saved me countless times.
I like that systematic approach. I use something similar based on delta. I start getting concerned when my short option delta approaches 0.30, which means it's getting closer to being at the money. At that point, I'll either roll the spread out in time to collect more premium or close it entirely if I've changed my market outlook.
That's a solid approach too. Let's talk about some specific success stories. Last quarter, I had a particularly successful trade on Microsoft after their earnings. Instead of trying to predict the direction, I used an iron condor, essentially combining a bull put spread and a bear call spread.
Nice. Taking advantage of the elevated IV before earnings, but not needing to be right about direction.
Exactly. MSFT moved less than expected after earnings, IV crushed, and I closed the position 3 days later for 75% of maximum profit. The beauty was that Microsoft could have moved either way within a reasonable range, and I'd still profit.
That's a great example of using credit spreads strategically. One of my recent successes was with SPY during a period of consolidation. I noticed that after 6 weeks of choppy, range-bound trading, many traders were buying straddles and strangles, anticipating a breakout. This pushed up option premiums.
So you sold into that elevated premium?
Precisely. I sold weekly credit spreads just outside the established range, collected rich premium, and watched time decay do its work as the consolidation continued. I repeated this for 4 consecutive weeks, averaging about 15% return on risk each week.
That's impressive. It shows how credit spreads can thrive in markets that would frustrate directional traders. But we should also talk about failures to give a balanced view. Want to share a trade that didn't work out?
Definitely. One of my worst credit spread trades was on Amazon during a previous earnings cycle. I got greedy and sold spreads too close to the current price to collect bigger premium. When they announced unexpected investments in new technologies that would hurt short-term profits, the stock dropped 12% overnight, blowing through my short strike.
Ouch. How did you manage that situation?
Not well initially. I made another classic mistake, hoping for a recovery. Instead of closing for a manageable loss, I held on and the position hit maximum loss. It taught me a valuable lesson about respecting stop losses and not letting hope guide trading decisions.
That's such an important lesson. I had a similar experience with bear call spreads on Tesla during its meteoric rise in 2023. I kept thinking it can't go higher, and I kept getting burned. Eventually, I learned to stop fighting strong momentum, regardless of valuation.
The market can stay irrational longer than you can stay solvent, as they say. Let's wrap up with some actionable advice for our listeners looking to implement or improve their credit spread trading.
Great idea. My top 3 tips would be, first, start small, 1 or 2 contracts until you're comfortable with the mechanics. Second, focus on high liquidity underlyings like major ETFs or large cap stocks. And third, consider closing positions when you've captured 50 to 80% of maximum profit, rather than waiting for expiration.
Excellent advice. I'd add, always know your maximum risk before entering a trade. Choose strikes with at least a 70% probability of success, and never risk more than 5% of your account on a single position. Also, consider entering credit spreads about 30 to 45 days before expiration to capitalize on accelerated time decay.
Those are great points, Ben. I think with these guidelines, even traders with smaller accounts can start using credit spreads effectively to generate consistent returns.
Absolutely. And remember, it's not about hitting home runs every time. It's about consistent singles and doubles that compound over time. Defense wins championships in options trading.
Well said. That wraps up today's episode of the Options Blueprint. We hope this deep dive into credit spreads has given you some valuable insights and strategies to implement in your own trading.
Thanks for joining us today. If you found this episode helpful, please subscribe and share with fellow traders. Until next time, trade smart, manage risk, and keep building your options blueprint for success.
See you on the next episode.